Welcome back. First quarter earnings season winding down now, and due to the Republican tax reform bill, it has been the best earnings season since 2011. According to the Wall Street Journal this morning, more than half of the net income growth reported by the 200 largest public companies came from lower tax rates. Joining us this morning is ERShares CEO and Chief Investment Officer Joel Shulman. Joel, good to see you. Thanks so much for joining us.
Good morning. Good to be here.
So this savings from the tax cut plan has companies passing it on to investors.
Right. And so, Apple yesterday, or a few days ago, announced it came in with $269 billion extra cash from offshore, and that's going to be about $1 to $2 trillion collectively when you think about all the companies along with Apple, like Microsoft and other companies like that.
Big earnings period.
Well, in these, so we got the tax savings. It's going to buybacks, and we're seeing huge buybacks here relative to last year. Talk about what that means for the market. Talk about what it means for the economy, because you get a lot of critique that, well, this is all going to buybacks. It's not going to help out the economy. What do you say to those arguments?
Yeah, so this is a great question. So collectively, there's about $1 trillion just for the top 20 or so companies, large companies that are publicly traded. But if you think about that, if Apple represents 4%, 5% of the global or the U.S. Equities, we're talking about maybe $2 trillion on the high end. $2 trillion when we think about the equity markets. I mean, we've got mutual funds about $18 trillion. We've got ETFs about $3 trillion. I mean, this is a big impact. When you're bringing, and this is unprecedented to have $1 to $2 trillion coming into the market. So it's going into R&D. I mean, big companies like Apple. Like Amazon and Netflix. I mean, they're pouring billions of dollars in R&D and job growth. I mean, we're seeing these publicly traded entrepreneurial companies last year increase by about 200,000 to 300,000 jobs. This year's probably going to be more.
Wow. And so you talk about entrepreneurial funds. How do you mentioned kind of going after those opportunities. How do you define that?
Yeah.
What's your criteria?
Yeah, thanks. So we've been doing about 13 years. So, year to date, it's the number one U.S. large cap fund. It's gone up about 9% out of 870 funds.
It's great to see a global entrepreneurial fund become large cap growth in the U.S. No, I mean it.
Well, I mean,
you think of small companies when you think of entrepreneurs.
You do, but it's easier to identify large cap entrepreneurial companies like Apple versus Hewlett Packard years ago when Steve Jobs was running. It's easier to identify those than nano caps or micro caps, where they all tend to look alike. We also look at mid caps and small caps, but going back to your question, we look for founder CEOs typically. We look for companies that have high ownership among the senior team. We look for a team that doesn't turn over. They grow organically. They have reinvestment back in R&D. They're buying the stock and holding on to the stock. Their compensation tends to be lower than other companies, so they're not taking $20 million salaries and then having $500,000 in ownership. It's the other way around. So these are companies, and the CEOs, by the way, have a long-term stake in it. They're staying 10 plus years rather than 3 to 5 years like most corporate CEOs.
Now, how do you, what's your perception of how these CEOs are feeling about the labor shortage and the growth? I mean, obviously it's great that they're investing, right, and taking a long-term view, but are they optimistic about the job market? Are they optimistic about continued growth? Because there's also concern about rising labor costs and rising production costs.
You're right. These are people who, it's more than just the money to them. I mean, this is their legacy. This is their livelihood and their long-term view. So, they take care of their team. They tend to have low turnover, as a group. And again, when you think about the S&P 500 overall, there's about 24 million jobs, and it's not really moving that much. I mean, it's really 17 or so of these entrepreneurial type companies that are creating job growth.
How important is the jobs number to you this morning? 192,000 jobs expected to have been added to the economy with a 4% unemployment rate expected.
Yeah, so I think job growth overall, it's hit or miss, right? I mean, you're looking at older companies that are just kind of hanging on, and maybe they're going down a little bit. You've got a lot of companies trying to cheat the numbers because they'll acquire other companies, and that doesn't always get reflected properly when you look at databases because they gobble up one company to another, and you got to back that out. In terms of the acquired growth and the firing. So most large companies are actually, firing companies. They acquire and they fire.
Are you encouraged about what you're seeing in China right now? We got the trade talks. Are you feeling good about that, or does this look like a long, uncertain road ahead?
It's going to be the latter, long, uncertain road. I mean, when you think back to what's happened over the last 30, 40 years, that in terms of what's going on with forced joint ventures and forced technology transfers. I mean, they've gone from a period where in 1981, we had a $3 billion surplus, and now we're looking at hundreds of billions of dollars of deficit, and this didn't happen overnight. And when you think about China relative to the global, economy, I mean, they're as big as the EU, and 25 years ago, they were 6% of the EU. So there's a big change. This is long overdue.
Do you see flows going in any specific direction right here?
So year to date, we've seen flows about 40 billion, 50 billion into international equities. It's still going to ETFs versus mutual funds. Mutual funds kind of flat to negative. ETFs are going up. In the last 6 months or so, ETFs have grown about $1 trillion. So we're still seeing flows, but right now it's U.S. large caps, but also international equities.
Just by the way, to that question, that investors have exited U.S. equity funds for the third straight month. So there have been outflows. As the market's been struggling since early February, and people have been pulling their money out of U.S. stock funds.
It's interesting to see people look at international even more attractive. Like we've heard a lot of people come on this program and say emerging markets is the place to be. Right. That's where the growth is. And you're saying international in general, not just emerging markets.
Right. Well, China was down 20% year to date, although Macau, which is part of China, has done well, and that's primarily because of the casinos. Finland, Italy, tend to be leading year to date in terms of performance. And there are pockets throughout the world that I think we're still going to see some opportunities.
Joel, great to have you on the show.
Thank you very much.
Thanks so much. Joel Shulman joining us there.